This right here is the Federal Income Tax Code. This is over 2,000 pages long. And what it says is, this is what income is, these are what your deductions are, these are what your write-offs are. And I can tell you I have this because I went through law school, and what I can tell you as an attorney, who's not your attorney, is that real estate has some of the biggest and most powerful tax deductions and write-offs that our tax code has to offer. By the way, this book is over 2,000 pages long. Number one is because of the deductions you get, aka write-offs. Now, before you go and implement any of the things that I talk about, talk to an accountant in your area. This is not financial advice. You have to talk to an accountant because all these things are very heavily regulated. So you want to make sure that whatever you're doing is legal. You don't want to run into red flags or run into issues with the IRS. Number one, with deductions, when you invest in real estate, you are essentially starting a business, and your business is investing in real estate, and businesses get to write off some of their business expenses. What can some of these business expenses include? Well, if you're investing in real estate, you need a car to get to and from work. You can potentially write off a piece of your car, or the car value, or your lease, or your car payment. You need gas. You can write off some of your gas. You need a cell phone to operate your business. You can write off some of your cell phone. You might need meals. You can write off some of these meals. So there are many write-offs that you can use, deductions, because now you are investing in real estate, which lower your taxable income. See, for most people, when you're a W-2, when you're an employee, the way that your income statement looks is you make money, then you pay taxes, and then after you pay taxes, that's when you pay for your expenses. But when you own a business, or if you own real estate investments, now it's kind of flipped. Now what you do is you make money, and then you pay for your expenses. Now, of course, you can't write off things that aren't related to your business, but you have to be smart here, and your accountant's gonna work with you to see how you can write off the most things possible legally. That way now you can file more expenses legally. No, you pay these expenses, and then you pay taxes on whatever's left. That means now you have a lower taxable income. If you have a lower taxable income, that's a lower tax bracket, meaning lower tax rates. Not only are you paying less dollars in taxes, but you're also paying a lower tax rate because now your expenses are here instead of here. Then after your deductions, you also get the value of depreciation, which means you get to tell the IRS, hey, my property is a year older. It has wear and tear, and because of that, I deserve a tax write-off on my taxes. Even if your property is more valuable, even if you have no real physical wear and tear, you still get to write off this depreciation against your taxes, which means you get more money in your pocket while paying less money in taxes. Let me show you. Going back to this example that I gave you earlier, where I bought this property for $500,000, and assuming that I buy it all cash, I'm going to get $35,000 worth of profit. This is the cash in my bank account at the end of the year. Well, in residential real estate, so this is homes, single-family homes or duplexes, in this type of residential real estate, you get a 27.5-year straight-line depreciation. I'll explain what that means. That's what it is at the time of the recording, and for commercial buildings, it's 39-year straight-line depreciation. What that means now is you can take the value of the property, divide it by 27.5 years, and that's how much you can deduct from your income, from your profit every year over that 27.5 years, just because your property is older. So how do you do that? Well, let's assume now for this $500,000 property, $100,000 is the value of the land and $400,000 is the value of the building. You can't depreciate the value of the land, but you can depreciate the value of the building. So now you take this $400,000 and you're gonna divide it by 27.5, which equals about $14,500. This is how much you can write off from your taxes every year just because your property is 1 year older. So now I go to the IRS, I say, okay, I made $35,000, and we'll assume that I have no deductions for the purposes of this example. And now we get to subtract $14,500 from my taxes. Remember, I still have 35 grand in my bank account, but on my taxes, I'm gonna write off this $14,500, which means my taxable income is $20,500. Now again, I have $35,000 in my bank account to spend, but I'm gonna tell the IRS I'm only gonna pay taxes on this $20,500, which means not only do I have to pay less money in taxes, but again, lower tax bracket because I have less income. But this is where things get really fun, because what happens if I didn't buy this property all cash? What if I use debt, like I talked about earlier? Now, in this example, I'm only going to pay taxes on my $20,500, even though I made $35,000 of profit. But if I bought this property with a mortgage. Now remember, I only had a $7,000 profit. So $7,000 worth of profit, but then I get to deduct this $14,500. So now I subtract this $14,500 and I have this negative $7,500 loss. I tell the IRS, hey, I lost money. I have this $7,500 loss, even though I have the $7,000 in my pocket. I made $7,000 on a financial cash basis. But in terms of taxes, I showed the IRS that I lost $7,500. Now, what you could potentially do if you qualify with your income, this is not for everybody, but some people are then going to be able to take this loss and deduct it against their own income. Now, at the time of me recording this video, in order for you to be able to deduct this loss against your ordinary income, your income from your job, you have to be making under $100,000 a year. And after $100,000 a year, this deduction gets faded out up until $150,000 a year. And the maximum that you can deduct is $25,000 in 1 year. And you also have to prove that you're actively involved in real estate. You have to show that you are some sort of real estate professional with your real estate investment. So again, this is why you want to make sure you have a good accountant on your side to do this. But there are ways for you to deduct some of this income against your ordinary income, the money you make from your job. Now, this is where things get even more interesting, because what if now you make more money, you don't have a job? What can you do then? Well, you can also carry forward this loss into future years. So now if you make a profit in a future year, well, now you can say, well, in the previous year I had this big loss, and you can keep carrying forward this loss. You're making money, but you don't have to pay any taxes. And the third big tax break that you get is something called the 1031 exchange, which says that you can sell your real estate for a profit and not have to pay any money in taxes if you take your profits and buy another property. So let's jump back to this previous example. You buy this home for $500,000. Now let's assume you own this property for a number of years. It's paying you cash flow, but then you're able to sell this property for $1 million. Pretty good. You made $500,000 of profit. Now you're also going to have to pay taxes on this $500,000 worth of profit, right? Well, maybe. Normally you would, but with real estate, you get this 1031 exchange, which says, okay, you have this $500,000 worth of profit, which would be taxable, but if you take this $1 million and you invest all of it into a bigger property, well, now you don't have to pay any money in taxes today. And now you can keep flipping this real estate year after year after year. You have to hold the property for just longer than a year, so you can't do this in 6 months. This is why you have to be an actual real estate investor. And then you have to buy bigger properties. Now, if you do this until you die, you never have to pay any taxes on this. But if you keep doing this 1031 exchange, you don't have to pay any taxes on the profits of this property. Now, again, this is very tricky. There are many regulations on this, so make sure you have a good real estate accountant and a good real estate attorney that will help you do this. So don't just go and blindly do this and expect not to pay any money in taxes, because if you just do this and you do it wrong, not only are you going to pay taxes, you're also going to pay penalties and fines. So make sure you have a good team, a good real estate accountant, and a good real estate attorney. Now, this brings me to the second reason why people love investing their money in real estate, which has to do with saving hard money. Now, of course, if you are a real estate investor and you want to stay up to date on what's happening in terms of the real estate market and the stock market and crypto and our economy and the global economy, then if you haven't already, join Market Briefs. Market Briefs is a completely free resource that I created to help you stay up to date on what's happening in the financial markets. It's a daily financial newsletter that breaks down what's happening in all the financial markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. It's super easy to read. So even if you don't have a financial background, not only are you going to understand what's happening, but you're going to look forward to reading Market Briefs every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. It's not how much money you make that's important. It's how much money you keep after taxes. The largest expense for many Americans is, well, taxes. And as an attorney, who's not your attorney, what I can tell you is that our IRS tax code is a rule book. It's a rule book that's over 2,000 pages long, going over what you should be paying taxes on and not be paying taxes on. And your goal is to pay the least amount of money in taxes legally. Not all income is taxed the same in the eyes of the IRS. That's why two people who earn the same amount of money can keep two completely different amounts of money after taxes because they're taxed differently, and two people can spend the same amounts of money while one person can get much bigger tax write-offs than the other, which is why it is very important that, especially if you are creating your own income, you're investing in real estate or doing other things like that, it is very important for you to have a good and smart accountant on your side. And even if you don't, well, an accountant can help you strategize your tax deductions and tax write-offs. That way you can maximize your deductions while also making sure you're following the rules. But what I want to do today is go over 7 different things that you need to know, that way you can pay less money in taxes legally. And of course, if you have specific questions, please talk to a licensed advisor in your area. Number 1 is understanding that you're not taxed on how much money you make. You're taxed on your net taxable income. If you invested your money into the stock market and one stock that you invested in made you a $10,000 profit that you sold, and then another stock that you invested in has a running $5,000 loss, well, if you sell this investment, you have $10,000 worth of taxable income. Now, if you also sell this investment for a $5,000 loss, this brings your net taxable income down from $10,000 to negative $5,000. Because you're not taxed on how much money you earn, you're taxed on your net taxable income. Now, of course, you have to actually sell this investment and realize the loss to net this out. But if you have losses, you can use some of your losses to negate some of your wins when it comes to investing. Now, this is where the natural next question is, okay, if I had this loss in my stock market investments, can I use this loss to offset some of my taxable income from my job? And the answer is, well, it kind of depends. The IRS generally likes to compare apples to apples. And so what that means is, first they're going to categorize your income, because like what I was saying earlier, not all income is treated the same. If you invest in something, whether it's stocks or real estate, and you hold on to it for longer than a year and then you sell, this is called long-term gains or long-term losses. If you hold on to an investment and you sell it in less than a year, this is called a short-term gain if you make a profit, or a short-term loss. The money you make from your job is called your ordinary income, otherwise known as your earned income. So now, if you have long-term gains and long-term losses, you invest in the stock market, you hold on to your investments for longer than a year, and some of your investments make money and some of your investments lose money, you can net those out right here in your long-term category. If you have other short-term investments where you invest your money, say in the stock market again, and you sell these in less than a year, well, then you can negate your gains and losses in your short-term investments here, and then you're going to have your ordinary taxable income, which is now the money you make from your job. You're going to pay taxes on the money you make from your job. This is generally going to be treated in its own lane, but there are some exceptions to this rule. The general rule is that you can deduct up to $3,000 worth of capital losses against other types of income if you are married. If you are single, filing a single tax return, then it's $1,500. So if you have a $1,500 short-term loss, you can deduct up to $3,000 worth of capital losses on your investments against your ordinary income. If you have an even bigger loss, well, then you can carry that forward to future years. The second thing that you can do is maximize tax-deferred accounts. This might be something like a 401k or an IRA or a SEP IRA or an HSA. 401ks along with 403bs and IRAs are tax-deferred retirement accounts, meaning they are investment accounts that you can put your money into where you can kind of grow your money tax-free. Now, there are some rules and restrictions with this, the whole idea being if you use a traditional 401k or a traditional IRA, you can invest your money into these accounts tax-free, meaning when you put your money in, you don't have to pay taxes on the income. So if you take $5,000 from your income and you put this money into your traditional 401k or your traditional IRA, you don't have to pay any taxes on that $5,000 today. That $5,000 can then grow over the course of your career, and then when you're ready to retire and you pull your money out, that's when you'll pay taxes on a traditional 401k or a traditional IRA. Now, if you use a Roth 401k or a Roth IRA, now you're going to pay taxes when you put your money in. So if you take that $5,000 and you put it into your Roth IRA or a Roth 401k, you're going to pay taxes on that $5,000 today, and then you'll have the after-tax dollars actually being invested. But now your money can grow tax-free, and then when you pull your money out, you can generally pull your money out tax-free as well. If you are self-employed or you have your own business, now you can use something called a SEP SEP IRA, which is a little bit different than a regular IRA because your limits of how much money you can invest are a little bit different. With a SEP IRA, you can invest up to 25% of your net earnings from your business up to $66,000. Essentially, that means you can take a big chunk of your profits from your business, put it to work in this investment fund, and not have to pay any taxes on this money that you earn today. And then you can grow that money tax-free, and then when you pull your cash out, that's when you'll pay taxes. After that, you also have the option to use an HSA, which is a health savings account. Now, before I jump into HSAs, if you do want to learn more about how to actually invest your money yourself, that way you can get better returns, get some of the tax breaks, and start generating cash flow, even if you don't have a ton of money, my company, Market Insiders, has a free ebook on how to start investing and how to start generating passive income. So if you want to learn more about how to start investing and build your investment portfolio, you can read this ebook for free, and I'll put the link to how you can download this ebook for free down in the description below. The way that HSAs work is you can put a little bit of money aside, tax-free, into this account, which then you can use to pay for things like deductibles or co-pays or some other qualified medical expenses that you have to pay out of pocket. So now you can essentially pay for these expenses tax-free if you put this money into an HSA. Now, the caveat here with the HSA is you have to have a high deductible with your health insurance in order to qualify to have an HSA. That means you have to have a high deductible health plan, or HDHP, and in 2023, the minimum deductible you have to have on your health insurance to qualify for an HSA is $1,500 for an individual or $3,000 as a family. The third thing that you can do is take advantage of the new clean energy tax credits. In 2022, President Biden signed the Inflation Reduction Act, and one of the provisions in the Inflation Reduction Act was that if you spend money to make your home more energy efficient, you can get a tax credit for that. This tax credit is available from now until 2032, and it gives you a 30% tax credit on energy efficient improvements on your home. Now, of course, this includes things like solar panels, but it also includes things like replacing your exterior windows, replacing your exterior door, improving your AC, and improving your furnace. Now, there are some rules associated with this, so definitely talk to an accountant or at least read the rules before you go and actually implement this, but this is a way now for you to improve your home and get a tax credit while you're doing that. Number 4 is really understand that not all income is taxed the same way. According to the IRS, there are 3 general categories of income. You have earned income, otherwise known as ordinary income, you have a portfolio income, and then you have passive income. Your earned income or ordinary income, this is the money you make from your job. This is your W-2 income. Your portfolio income, this is the money you make from things like your stock market investments. If you hold onto a stock and you buy a stock and you sell it for a profit, that is your portfolio income. Passive income would be something like your rental property income. If you own a rental property and it's paying you with cash flow, that is your passive income. Do you want to know which of these 3 different types of income comes with the highest tax rates and the lowest tax write-offs? Well, it is your ordinary earned income. The money you make from your job comes with the highest tax rates and the lowest tax write-offs. When you go and invest your money in something like the stock market and you hold on to this for the long term, well, now you qualify for long-term capital gains. And at the time of recording this video, the top tax rate for long-term capital gains income is 20%. While at the same time, the top tax rate for now your earned income is closer to 40%. So if you make a lot of money, and you make a lot of money from your job versus a lot of money from your investments, well, you can pay much less money in taxes on your investment income than your earned income, just because that's what the tax code says. What does this mean? Well, it goes back to the importance of being financially educated, because now if you are investing your money, because not everybody can be a business owner, not everybody's going to go out and invest in real estate, but everybody can be an investor. If you start investing your money, well, now you can take advantage of some of these lower tax rates and you're building wealth while you're doing it. Now, of course, if you want to learn more about this, you can check out my free ebook down in the description. Number 5 is maximize your deductions, especially if you have your own income. So if you're self-employed, or if you have your own business, or if you're investing in real estate and you're creating your own income, now you can definitely try to maximize your own expenses and write-offs. Now, if you don't have your own income, this is where you want to make sure you at least maximize the standard deduction. See, the way that your taxable income is calculated is you make money, whether it's from your job or your business, you take your deductions, and then this is now your taxable income. If you don't have a lot of write-offs, you can at least maximize your standard deduction. This is what everybody can qualify for. But if you create your own income, if you're self-employed, if you have your own own business. Well, now the question is, how can you maximize these deductions in a way that will give you value for your business and maybe some value for your life as well? 2022 was my biggest year for travel really ever up until now. And in 2022, I spent a lot of time in Airbnbs, a lot of time on planes, a lot of times in hotels. And I had to spend a lot of time in different parts of the country. Like I spent maybe 2 months or so in San Diego. I spent about a month and a half in Manhattan. And when I went, I lived there with my business partner. So now me and my business partner are living in an Airbnb. We had to go fly out to these places. And then I had to go and work there. I had to eat at restaurants. I had to meet with people and do a lot of business there because I went there for business. But along the way, I also got to spend time in San Diego and Manhattan, which are beautiful cities. Now, I should also clarify that my business partner is my wife. And so now me and my wife got to go to these places like San Diego, and there was a tax deduction. Yes, I was there for business. I was meeting a lot of people. I was doing a lot of interviews. I was working with a lot of people. I was there for work. But the expense to go there and live there now became a tax write-off because, well, I had to go there for work. This was a deduction. Same with meals. In 2022, there was a 100% meals deduction because we were just coming out of the pandemic, which meant if you went out and ate at a restaurant and you had a business meeting, if you were eating with your employees, if you were eating with business partners, if you're meeting with other clients, well, now these meals that you're eating at these restaurants are a 100% write-off. Now, it's still a write-off, but not a 100% write-off. Another popular deduction right now is the Section 179 deduction, which is a heavy vehicle deduction. Essentially what it says is that if you need to buy a heavy vehicle for your business, well, then you can write off a big chunk of that vehicle right now. Like in 2022, my accountant called me and asked me, Jaspreet, what are your thoughts about a G-Wagon? And I was like, well, they're nice cars. What do you mean? He's like, I think you should buy a G-Wagon. I was like, why are you saying that? And he said, well, because we have the Section 179 deduction, which says that if you go out and buy a heavy vehicle like a G-Wagon, then you can write off a big chunk of the vehicle over your taxable income. So you can reduce your taxable income because now you have a G-Wagon. And I was like, well, I don't really need a G-Wagon. I don't really want a G-Wagon. I don't know if I should do that. And he said, look, you are an influencer. You have this brand on social media. And because you do, well, then you can justify to the IRS that you need a G-Wagon to justify this lifestyle and this influencer brand. Now, I didn't go out and buy a G-Wagon because for me, I don't want to go out and just spend $1 to save 40 cents on taxes. I'd rather use that money in a place that's going to give me a bigger return on my business. But you saw a lot of people going out buying Hummers and pickup trucks and heavy trucks because now they wanted to capitalize on this Section 179 deduction. I'm going to talk about real estate even more in just a minute, but another deduction that's been very popular amongst real estate people is travel deductions. Because now if you go fly to Florida or you fly to Hawaii and you're going there to look at some real estate, even if you don't buy any, well, now you're going there with the intention of looking at real estate. Maybe with a real estate broker. Maybe you look at some properties. Well, now if you do that, if you go there with the intention to look at real estate, well, now that trip, that little vacation that you had to Florida or Hawaii, is now a tax write-off because you're going there for business purposes. Yeah, maybe you have to go and eat at some nice restaurants. Maybe you have to play golf there while you're on this business trip. But if you're going there for business purposes, now the trip can be a tax write-off. But again, this is where you have to make sure you have a good licensed accountant on your side, because this person will now make sure what you're doing is in line with what the rule book says, and they will make sure that you stay out of trouble because you don't want to now press the line and then get audited and then have to pay a whole bunch of money in fees and fines. So make sure you do it the right way. The sixth thing that you can do is use debt strategically. Now I'm going to talk about this on a big scale, then kind of talk about it on a smaller scale. But a fun kind of example of this is in the terms of buying a plane. Let's assume now that you run a business and your business made $10 million of profit, so you're making a lot of money. You have $10 million in the bank account, and that means you're going to have a big tax bill associated with that. Well, if you go out and you buy this $20 million plane, that is supposed to be a plane, this plane costs $20 million. Well, you don't have $20 million to go out and buy this plane, but what you can do is you can finance this plane. You can go out and put down $2 million to buy the plane and then finance the other $18 million. So you got $18 million worth of debt. You put down $2 million. Now you own this plane and your bank account has $8 million. Well, now what you can tell the IRS is, yeah, I made $10 million. We only have $8 million in the bank account, but I bought this $20 million plane. So now you can take a $20 million write-off on your taxes. So now you tell the IRS, my taxable income is negative $12 million because you financed the plane. Now you have a plane, you have $8 million in the bank, and you have $0 of your tax bill. Then next year, if you make another, say, $10 million, well, now you can take this negative $12 million and use it to negate these taxes as well. And then you can tell the IRS, hey, I made another $10 million. I have this $12 million loss from the previous year. And now you show that, well, I have a negative $2 million taxable income again. And then you can carry this $2 million loss into the next year as well. And now you're going to use your income to, well, pay down your payments on this plane. Of course, anytime you take on more debt, it comes with more risk, but this is where now you can see how if you use debt strategically, it is a way for you to also limit your taxes. How else do people do this without buying planes? Well, you've seen people do the same thing with cars. You can do this with business machinery. The key here is you want to make sure that you're not over leveraging yourself to really run into financial danger where now you're trying to finance all these things to limit your taxes, but now you're on the verge of going bankrupt. So again, don't just spend money with the goal of spending $1 to save 40 cents. Spend money strategically in a way that's going to help you increase how much money you're making, and if you can get a tax write-off for that, even better. But don't get into the habit of spending $1 to save 40 cents because you're still losing 60 cents along the way. And then finally, number 7 is invest in real estate, because now you can generate cash flow. You own a hard asset, something that you can see, feel, and touch, and you get the tax breaks that real estate has to offer. I know a lot of people who are doctors, and a very common question that I get from all of my doctor friends, especially when they start working, they start making the big bucks, is, man, I'm paying a lot of money in taxes. Is there anything that I can do? And one thing that I always recommend is go out and invest in real estate, because now you'll be working to build wealth, you own a hard asset, and you can also benefit from some of the tax breaks as well. So let's assume now that you went out and you bought this property. Let's assume it's $1 million. You could do the same with a $100,000 property. The same concepts apply, but you buy this property for $1 million. And this property, let's assume that it generates $50,000 a year of profit from cash flow. So this is a 5% return, $50,000 worth of profit. Well, now not all the income is going to be your taxable income, because now you also have to take out your other deductions. So we already took out the deductions for the building. That's how you got this $50,000 worth of profit, because maybe you generated $200,000 of revenue, but then you have to pay for your property manager, you have to pay for your water bill, you have to pay for the utilities, you have to pay for the maintenance, which brought you down to $50,000. Rough numbers. Now, out of this $50,000, you have to pay for your other business operating expenses. Maybe you have to have a cell phone to run the business. Maybe you need a laptop to run the business. Maybe you need your truck to run the business. Maybe you have to pay for gas to run the business. Maybe you have some meals for the business. So now you can write down some of these expenses, which, let's just assume your business expenses bring you down to $40,000 worth of net income. The next thing that you can do is you get to tell the IRS, hey, this property that I bought is 1 year older, so I deserve a write-off for that. That is called the depreciation deduction, where now you depreciate the value of the building. So now this is where the first thing you have to do is you have to separate the value of the land from the building. So let's assume that when you bought this $1 million property, $200,000 was the value of the land and $800,000 was the value of the building. Well, now you can write off a piece of this $800,000 every year until you write off the entire building from your taxable income. Let me show you. If you invest your money into a single family home, then you will get to write off 1/27.5 of the value of the building each year over 27.5 years. If you now buy a commercial building like this one is, then you get to write off 1/39 of the value of the building. So now we know that the value of this building is $800,000. You take the $800,000, you divide it by 89, which is just over $20,000, which means that now you get to take an additional $20,000 write-off just because now your building is 1 year older. This is what's called a paper deduction. You have $40,000 in your bank account, even though this property made you $50,000, then you had your other operating expenses. So now you made $40,000. You take this $20,000 depreciation deduction, which is only on paper, and then you tell the IRS, hey, I only had $20,000 worth of taxable income. Now you have less taxable income, which means a lower tax bracket, which means lower tax rates, which means less money that you pay in taxes. Now, again, you have $40,000 in your bank after paying for all these expenses, and you're only paying taxes on the $20,000. Again, this is why you want to make sure that you talk to a licensed and professional accountant in your area, because there's a lot of rules and a lot of regulations, especially when it comes to real estate investing, and you want somebody who is a professional to guide you, because you want to stay away from the red flags and make sure you follow what the rules are. Most people assume that successful people have to either ignore all the fun things that life has to offer or that you got lucky, but that's not the case. If you want to become successful, there are 7 things that every successful person tries to avoid, and number 1 is taxes. Now, before you go out and stop paying taxes, let me clarify what I mean here, because as an attorney who is not your attorney, there are certain things that the IRS tax code allows you to do with your money which allow you to legally pay less money in taxes. There's a difference between tax avoiding and tax evading. Tax avoiding is when you're using the IRS tax rule book to do things legally that allow you to pay less money in taxes. Tax evading is illegal and you'll go to jail. The first thing that you have to understand is that the IRS doesn't tax you on how much money you earn. They tax you on your taxable income. These are 2 completely different things, because now you take the money that you earn and then you're going to show all the write-offs and deductions as possible, and then that is going to leave you with your taxable income. So the first question that successful people ask is, how can I have more write-offs and more deductions legally? Now, there's no way for me to go over all the different ways to do that. I mean, the federal income tax code right here is over 2,000 pages long of extremely tiny font. So there's a lot of different information here. The best thing to do is to get a CPA, get an accountant who not only will help you file your taxes, but also do tax planning, because if all your CPA is doing is filing your taxes, you are leaving a lot of money at the table. Tax planning is now where you work with the CPA, you're working with the accountant to come up with a plan on different things that you can do with your money, that way you can pay less money in taxes legally. The big thing that I want you to understand here is that the IRS tax code essentially pats you on the back if you create your own income or if you are an investor. So let me explain what this means. If you are a W-2 employee and all you earn income from is the job that you go to, so you get a paycheck for the work that you put in and you are a W-2 employee, then what happens is you make money from your job, you're going to pay taxes, and this is probably going to be automatically deducted out of your paycheck, and then you get to spend whatever's left. So now if you want a car, you got to spend this money after tax dollars. If you want a phone, you got to spend these after tax dollars. If you want to go to California, you got to spend these after tax dollars. If you create your own income, so if you are a business owner, you're a 1099 worker, now you're creating your own income, now it's a little bit different. So I'll call this your own income. Now you're going to make money, whether it's from your business or your 1099 income, and then you get to spend this money, because now you can have qualified business expenses. These are called ordinary and necessary expenses, where now you could tell the IRS, hey, I need a cell phone to run my business. I need a laptop to run my business. I need a car for my business. I need to go to California to meet with some people for my business. Now you get to spend money here, and then you pay taxes on whatever's left. That means you have a smaller taxable income because you paid the expenses first. Now, not everything is going to qualify as an expense, but you have to show that it's ordinary and necessary, and this is where a good accountant can help with that. That means if both of these 2 people were to earn the same amount of money, if both of these people both earned $100,000, they get to keep different amounts of money after their taxes, because, well, that's what the IRS tax code allows. The second thing that I want you to understand about the tax code is that all income is not treated the same. Like what I said earlier, the IRS pats you on the back if you create your own income or if you're an investor. Well, you'll see that here. There are 3 general categories of income according to the IRS tax code. You have ordinary income. This is the money you make from your job, your W-2 income. You have your portfolio income. This is essentially your investment income. If you buy a stock and sell it for a profit 2 years later, that's considered portfolio income. And then you have passive income. This is the income you make from a business that you passively own. This could be something like real estate rental income. Do you want to know which taxable income has the highest tax rate and the lowest amount of tax deductions that you can take? Take a guess. Well, this one right here. The money you make from your job. You're going to pay the highest tax rates here, and you get the lowest deductions. As you can see from the previous example, you get more deductions when you create your own income, and those are things that you could potentially qualify here under your passive income, because when you own real estate rental properties, you can have that benefit of filing a bunch of different expenses that are ordinary and necessary for your real estate business. And then your portfolio income, this is the money you make from your stock market investments that you sell for a profit after a year of owning them. Well, with these investments, you get a lower tax rate. The top tax rate with portfolio income is right around 20%. The top tax rate when it comes to your ordinary income is about double that. I don't want to go too deep into tax strategies in this video because I've made other videos where I explain that. So if you want to learn more about different tax strategies that you can use, I'll link a video that you can watch down in the description below. The second thing that wealthy people avoid are payments, especially on things that aren't making them any money. We live in this kind of fast food microwave culture when we want something, we want it now. We don't want to put in the work to actually be able to afford it. We just feel like we deserve it, so we should buy it now. And now with the help of all the financing available, buy now, pay later, credit cards, easy financing, 0% APR, it is easier than ever for people to qualify for things that they can't afford. Just because you can buy something doesn't mean that you can afford it. And now what are we doing? Well, we're justifying liabilities as assets. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. So now when you go out and you buy your clothes, your shoes, your vacations, or even your car, these are liabilities that are pulling money out of your pocket. Now, when you go out and you finance these liabilities, when you go and finance your clothes, you go and finance your shoes, you go and finance that Gucci, or you go and finance the car, you're paying interest on something that is losing value. The average new car payment at the time of me recording this video is $717 a month. That doesn't include the insurance, that doesn't include the maintenance on your new BMW, that's just the new car payment. Now, if instead of taking this new car payment and using it to buy a car that's losing value, you took this $717 a month and you just put it into the stock market. You put it into an ETF, an exchange traded fund that's giving you exposure to the total stock market or the S&P 500. You just put your money into there. Now, historically, we have seen a 7 to 10% growth in the stock market a year over the long term. Does that mean that the stock market always goes up? No, but historically we've seen 7 to 10%. Let's assume you can get a 7% return on this money. You did this for 45 years. So now you start when you're 21 and you do this until you retire. Well, now instead of owning a car that's worth less than what you bought it for, you're going to have an investment account that's worth over $2.6 million. Because what happens now is you are working to grow this money. When you're taking this money to buy a car, well, what happens is you're going to continue to pay off this car. As soon as you pay off the car, it's going to feel really weird because you don't have any car payments. So now you're going to trade it in and start the payment scheme all over again. And now you might be saying, but Jaspreet, I need a car to get to and from work. Yes, you need a car. You just want a BMW. Instead of having the $717 monthly car payment, which is the average car payment in America, how about you go and buy a $5,000 car or an $8,000 car with cash? Now, you don't have to worry about any payments. Yeah, you might have to downgrade from your BMW to a Toyota Camry, but now at least you'll have a decent, good working condition car. You won't have to worry about the payments, and you can work on taking this money and investing it. That way you can work to build your wealth before you make everybody else around you rich. When you are financing things that aren't putting money in your pocket, you're paying interest to buy something that's losing money. It's a double whammy. You're paying the bank and you're also losing money. The third thing that successful people avoid are time wasters. See, each one of us have two currencies in our life. The first currency is money, but the second currency is time. We've all heard people say that it takes money to make money, and that's a complete lie. It takes money to grow your money, but you don't need money to make money. You need one of these two currencies if you want to make money, or both. If you don't have money, then you got to sacrifice your time to make more money. That means you got to use your time to learn how to make more money, and you got to use your time in a way that's creative. That way you can earn more money. Once you can earn more money from your time, well, then you have more money that you can work to grow by investing this money. But right now, you got to focus on increasing the value out of the time that you have. Each one of us have 24 hours in a day. What are you doing in your 24 hours that will allow you to get the most output out of your 24 hours? If you're scrolling on TikTok all day and all you see on TikTok are people dancing and cat videos, how much value is that really adding to your life? But now if you're scrolling through TikTok and you're seeing financial videos, you're seeing entrepreneurial tips, you're seeing business tips, now you're getting a completely different value out of your TikTok. My friend Tom Bilyeu talked about this, where he has trained his TikTok algorithms to show him things that are providing him with value. So when he's going through TikTok, he's not going there to waste time, he's going there to learn. You have to train the algorithms in your life to give you the best return on your time. What I like to say is the best ROI, return on investment, that the average American can make is canceling their Netflix subscription. And it's not because you'll save an extra $10 to $15 a month, it's because you're going to save 2 hours a day. If you're spending every evening binging a couple Netflix shows, watching a Netflix movie, that is time that is being thrown away. That's not adding any value to your life. Instead of watching those Netflix shows, how about you go and watch some YouTube videos on financial education? How about you read some books? How about you work on a business idea? How about you start a side hustle idea? How about you learn something that can increase your income? How about you learn about how to invest your money? Now, if you do that for 6 months, I guarantee you are going to learn so much more than you would have if you continued with the Netflix subscription. So now, it's what are you doing with this time that way now you can actually do something to increase your income and increase how you grow your money. If you do that, you will be in a completely different place in 6 months, in 12 months, and 18 months, but it requires you to make a sacrifice. The fourth thing that all successful people avoid is overspending. And I kind of hinted at this a second ago, but there's a difference between a need and a want. You need a car, you just want a BMW. You need clothes, you just want the Gucci. You need a home to live in, you just want a mansion. There's a difference between something that we need to buy and something that we want to buy, and what we end up doing is we justify our needs as wants. That way we can go out and spend money we don't have on something we don't really need. But if you're really working to build your wealth, you can't keep spending your money because that means you have less money to invest in yourself. And this could be in your own education. This could be into the stock market. This could be into the real estate market. This could be into business. This could be into something else where you want to put this money that will actually grow. Your Gucci isn't going to make you any money, but your business idea can. Your BMW isn't going to make you rich, but your investments might. And this is where you have to flip the script and stop overspending on the things that aren't making you any money. That way you can overspend on the things that will make you money. Overspend right now on your investments. That way you can spend whatever you want on the liabilities. That way you can spend whatever you want on the cars, the trips, the vacations, and everything else when you can afford it. And the way that you can do that right now is by following like my simple rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. This is a simple rule of thumb that you can start using that when before you go to the store and buy the $100 pair of shoes when you only have $100 in your account, you know that just because you can buy something, you can't afford it. This is where now you have to understand that there's a difference between being able to afford and being able to buy, and what will help you get there is by differentiating needs versus wants. Number 5, avoid toxic things. We are products of our environment. And if your environment right now is toxic, if everybody is bringing you down, if everybody's trying to get you to spend money on things that you don't want to spend money on, if everyone's trying to get you to go into debt, if everyone's making fun of you for you trying to work on your financial future, if everybody is really draining you emotionally, you got to find a different environment for you to live in and to thrive in. Now, you might not be able to go and find a whole new group of friends right away, but now you can find digital groups to hang out with. Find YouTube communities, find Discord channels, find different places where you can hang out online that we can make friends and network with people who have a similar mindset as you. Because when you start your financial education journey, everyone's going to think you lost your mind. When you stop spending money with everybody else, when you stop going to the club, when you stop partying, when you stop traveling and you start spending money on yourself, people will not understand and they'll tell you that you changed. And they won't like it. But you are trying to grow. You're trying to achieve something that you've never had. You're trying to give your family something that they've never had. And that's going to require you to make sacrifices and make change. And if everybody's trying to bring you down, or if people are draining you emotionally, if you are in a bad relationship, if you're in a place where people are really bringing you down, you have to find a way to get out of that toxic environment. The 6th thing that wealthy people avoid is they avoid letting their short-term desires get in the way of their long-term wants. The best example of this was a story or something that I read years ago when I was trying to get in shape. Was somebody was talking about how when you want to eat that chocolate bar, you want to eat the bag of chips, you want to eat something unhealthy, tell yourself this, that you've been wanting this bag of chips for 15 minutes, but you've been wanting the 6-pack for 15 years. So don't let that thing that you've been wanting for 15 minutes overcome what you've been wanting for 15 years. And this is really developing the long-term mindset. And this is especially important when it comes to your money, because when you're investing your money to build wealth, you're investing for the long term. And the biggest criticism that I hear when people talk about investing their money to become wealthy is, I don't want to wait 10, 20, 30, 40 years until I'm wealthy. I want to enjoy my money today. So YOLO, let me go out and spend my money, go into debt and enjoy my life today. Well, guess what? 10 years from now, that time is going to go by. And if you haven't started putting the plan into action, you're going to be older and in a deeper financial hole. 20 years from now, you're going to be even older and in an even bigger financial hole. So you need to start preparing today. That way when you do get older, that you can be more wealthy. But this requires you to stop being so focused on that short-term gratification and start focusing on the long-term gratification, working for something bigger than you, working for something bigger over in the future. And finally, the seventh thing that successful people avoid are distractions. When you're trying to get in shape, the best thing that I say is out of sight, out of mind. If you want to get in shape, get the cookies out of the house, get the brownies out of the house. Now when it's not there, you can't eat this stuff. Just like that, when it comes to your finances, you got to get the distractions out of mind. This is why I say cancel the Netflix subscription. Even if it's for 6 months, that way now you're forcing yourself to do something that's a little bit more productive. You're forcing yourself to go and read. You're forcing yourself to go and watch YouTube videos, educational videos. That way now you can work and start investing in your own education. You have to get away from the distractions. If your friends are constantly making you spend money on things that you don't want to spend money on, stop hanging out with your friends, at least for a little while. That way you can get your finances in order. If your parents are always making you feel bad for the car that you're driving, don't go and see your parents for a while. Talk to them on the phone. Do whatever you gotta do to get out of those distractions for a little while. That way you can get yourself in order, or at least so you can build your confidence. That way now you can be confident in what you're doing for your finances, because you know you're working for something bigger. And if everybody is draining you of your energy, if everybody's draining you of your drive and your momentum, you got to get away from that stuff, get away from the distractions, stop spending money on the things that aren't adding any value to your life. That way you can start working on your own life and build that confidence. That way you know that you're going to build your wealth and nobody else can bring you down from that. A few times a year, I get a call from somebody I know who just woke up. They've been working hard, they've been working to grow their income, but they have nothing to show for it, and it's always the same story. Bro, Jaspreet, I've been working for the last 15 years. I've been working to grow my career. I make okay money. I have some nice stuff, but I have nothing in the bank. I have no investments. I have no wealth. What do I do? So this video is going to be dedicated to answering that question. How do you get started to build your wealth? Because from now on, when I get these calls, I'm just gonna direct everyone to this video. Number one is get an income, but don't spend all of it. See, most of us think in terms of what I call net zero. You have $1,000 in the bank and now you think, what can this $1,000 buy me? Can I go on a vacation? Can I buy a nice watch? What can I do with this $1,000, which will take my bank account to zero? See, most of us think in this type of net zero spending. When we have money in the bank, we think, how do we spend it? But the quickest way to have more money is just to not spend all of your money. So the very first thing you gotta do is understand, when you earn money, you cannot spend all of it. This brings me to number two. You got to open up 3 different bank accounts. One bank account will hold the money that you can spend. This is your checkings account. One bank account will hold the money that you are going to invest, and one bank account will hold your savings. The reason why you want to have 3 separate bank accounts is so you don't accidentally spend your investment money, and so you don't accidentally buy a brand new TV with the money you're supposed to be saving. Now, this is where you want to automate this process, because it's going to allow you to live your life and know how much money goes where. So what you can do is create a system where now every time you get paid, some of your money is going to go here, some of your money is going to go here, and some of your money is going to go here. That way you have a system where now it's automated. You make money, and some of your money is going to be the money you can spend. You know this is the only money you can use to go buy a car. This is the only money you can use to go out to eat at nice restaurants. This is the only money you can use to go on vacations. This is the money that you can use for your investments, whether it's stock market, whether it's the real estate, whether it's cryptocurrency, whether it's a business idea, whether it's paying down debt. This is your investment money. This is the money that you're saving for emergencies, and you don't use this money unless you run into a real emergency. Your kid breaks their arm, your car breaks down, you lose your job. This is what the savings money is for. Now, what I say is start with something simple, something like a 75, 15, 10 plan. Now, what this says is for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum you're saving. This way, now you're paying yourself first before you go and make everybody else rich. What that means is when you go and spend this money, you go buy a nice car, you buy a handbag, you buy a watch, you go to eat at a restaurant, you go on a vacation, you are making other people rich because you're giving your money to somebody else. In these places, you're working to pay yourself first. Your wealth is not going to be built here. Your wealth is not built through your savings. This savings is just there to protect you against an emergency. You cannot outsave inflation, which means you cannot save your way to wealth. What that means is right now we have inflation. We have had inflation for a century, and we will continue to have inflation. The savings you have in your bank account is losing value to inflation. That means your savings are losing buying power. So why do we save money? We save money to protect us against emergencies. We don't save money to try to become wealthy. That's what you have to understand about the savings. Now, you should have a goal of how much money to save. You want to save somewhere generally between 3 months and 12 months worth of expenses. The amount of money is going to depend on where you are in life. If you don't mind taking on higher risk, if you don't have any financial responsibilities, you don't have kids, you don't have a spouse, well, then you might only want to save 3 months worth of expenses and invest the rest of the money. If you say, I want to be more protected with less risk, then maybe you want to save 6 months or 9 months or 12 months worth of expenses. This is going to depend on you and your risk tolerance and where you are in life. Now, once you figure out how much money you want to save, you save that much money and then you stop saving money because you don't want to just save your money to save it. You want to save your money strategically. That means save 3 to 12 months worth of expenses. Once you do that, then you stop saving money and you allocate the saving money towards your investments because this is where you become wealthy. This is the money you use to live your life. This is the money you use to go out to eat, the money you use to go on vacation, to go buy things. This is the money you use to become wealthy. This is where you're going to put money towards the actual investments that we can own assets that pay you for owning them. This is where your wealth is built. If you want to become wealthier, spend less money here, spend more money here. This is where you protect yourself so you don't have to worry about going into debt when an emergency happens. This is why you want to have 3 different bank accounts. That way it's separated, you know what money is for what, and then most banks will allow you to create some sort of automation like this completely free. Third, where do you put this money that you want to invest? That way you can actually become wealthy. And for the average person, where most people start investing is either in their 401k or their IRA. And let me start with this. Your 401k is not enough for you to retire and live financially free. It was never designed to be your sole retirement plan, and it should not be treated as your sole retirement plan. It's an okay place for you to start, but that's not where your investments should end. So you have your 401k or your IRA, which is fine, but you also want to invest money outside of just these retirement accounts. Now, before I talk about where you can invest this money outside of your retirement accounts, let's start by talking about the retirement accounts themselves. 401ks and 403bs work pretty much the same, so I'm going to categorize them together as this 401k section. And so let's talk about 401ks versus IRAs. So your 401k is issued by your employer versus IRAs are things that you go out and create yourself. Now, both of these are tax-deferred retirement accounts, meaning they are accounts which should give you some sort of tax benefits for using them. Now, the types of tax benefits you get are going to depend on whether you get a traditional or a Roth 401k or IRA. Now, before we talk about this, the one thing that I do want to mention is that when you invest your money into either one of these funds, well, you're going to pay a fee. So one thing that I want you to pay attention to is what is the expense ratio of the funds that you were investing your money in. And if you didn't know that your 401k or IRA has a fee, well, most people don't. NerdWallet did a study and they found that over 90% of Americans don't know what their 401k fees are. What is this fee? Well, when you put your money into a fund, an index fund, an ETF, all these funds have a fee for using them. Now, the fee that you pay is called the expense ratio. And this is where you want to know at least what the fee is to see if it's worth it or not. Generally, the lower the fee, the better it will be. Is that always the case? No, but generally that is the case. A 1% fee or 1% expense ratio will end up costing you about 28% of your entire investment portfolio over the course of your investment career. Why so much? Because it's not just a 1% fee that you pay today, it's a 1% fee that you pay each and every year on each and every dollar that you invest and each and every dollar that you earn. That's why these fees can be so expensive. So your $1 million investment portfolio can go down to $750,000 with a 1% fee if you don't know what the fee is and if you're paying a fee where you shouldn't. So the first thing I want you to do is just go and look at what your expense ratio is, and if it's really high, if it's above 0.4% or above 0.5%, I want you to consider if that fee is worth it or not. Now, once you know what you're actually investing in, the next question is, what are the different options that you have? Now, IRAs have a little bit of different options because IRAs have the potential for you to invest your money yourself. Like there are some IRAs that allow you to invest in real estate as well. So IRAs have a little bit more flexibility than 401ks, but generally the difference between a traditional 401k or IRA versus a Roth 401k or IRA is when you are taxed. So a traditional 401k and IRA, the way it works is you make money, you put it into this investment portfolio, and then you pay taxes at the end. So you pay taxes when you pull the money out when you enter retirement. So you make the money, it goes here, and then the rest of your income is taxed. So you get to avoid some of the taxes today, and then you pay taxes later on. That's how it works with a traditional 401k and IRA. With a Roth, the way it works, you generate this income right now, you pay taxes, and then you take this after-tax income and you put it into your investment. That's supposed to be an arrow showing that your money is growing. But you make money, you pay taxes, and then you take this after-tax income and you put it into this Roth 401k or Roth IRA. Now, the question is, which one do you do? And this is going to depend on what you believe is going to happen in the future. So the reason why some people like this traditional 401k or IRA is because they say, when I'm old, I'm not going to have a job and I'm not going to have an income. So my tax rates are going to be lower because I'm not going to have any money. So when I pull my money out later, I'm going to have a lower tax rate. On the Roth side, what people are saying is, well, I hope that I have a bigger income when I'm older because I'm investing my money, I'm working on my business, I'm working on whatever, so I can have our money. Or I'm also concerned where tax rates are going. I see where our national debt is. I see the issues with our economic health, and I see where our country is going. And because of that, I think tax rates are rising. So I'd rather pay taxes today and not have to worry about where tax rates go in the future. So I'm going to take the Roth. Now you got to decide which side you're on, and because of that, which one would you pick? So the Roth gives you a little bit more certainty on the tax side because you have to pay the taxes today versus the traditional. You don't have to pay taxes today. You have more money that goes into your investment portfolio today, but then the amount of taxes you're going to pay in the future is going to be a question mark. This is where you have to make the decision of which one you think is better. And with the Roth stuff, this has to go more onto the economic side of what's happening in the economy and our national debt. Those are the types of things that we cover in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, it's an easy way for you to stay up to date on what's happening in the financial markets and our economy. You can read Market Briefs for free for 5 minutes or less every morning because my team is breaking down what's happening in the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. So now what we talked about is when you earn money, you can't spend all your money. You got to be smarter here. Second, when it comes to investing in money, the first thing you can do is look at these retirement accounts, a Roth or traditional 401k or IRA. Then we also talked about the savings and why you don't want to save all your money. But those investment, the retirement accounts that we just talked about, is just the first way that you want to start investing. That shouldn't be the only way that you start investing. Now, outside of your retirement accounts, you have two different ways that you can start investing. What I like to call passive investing and what I like to call active investing. Let me start by talking about passive investing, which is now the fourth thing that you need to be doing. See, when most people think about investing their money, they think, how do I find the next Amazon? Or how do I find the next Microsoft before it becomes the next big thing? But for the vast majority of people, that's not how you should be investing, and that's not how you need to be investing, even if you want to be a millionaire investor. There are ways for you to create automatic passive investments that don't take much or any time on your end, that are just simple things that you set up, and now you don't have to worry about it, and you're getting exposure to the market. Because what we've seen happen over the last century is that the stock market has grown by an average of 7 to 10% a year. That doesn't mean that the stock market always goes up by 7 to 10% a year. That means on average over the long run, that's how much the stock market has grown by. Now the problem is, most people who try to invest their money in the stock market end up losing money, which doesn't really make much sense. The stock market is growing by 7 to 10% a year, and most people are losing money in the market. What's going on here? Well, when most people try to actually make money in the market, they're trying to find the next hot stock, and they don't know how to research a company. They end up overpaying for the company, and then they sell this investment for a big loss, or they just have no idea what they're doing. Versus if you just put your money into the market and get a broader exposure to the market, it's an easier way for you to invest because you don't have to individually research each company, and it can be completely passive and automatic on your side. How does this work? Well, instead of investing in individual companies, you can invest in a fund. There's a few different types of funds. You have index funds, mutual funds, and ETFs. Index funds, mutual funds, and ETFs are three different types of funds that give you exposure not to one company, but to a basket of companies. So what that means now is you're investing into a fund that is managed by something else, either a computer or a person that will then make sure that your investment portfolio is working to give you exposure to the investments that you thought that you were getting. So what does that mean? Well, you can invest into the total stock market. There are funds that give you exposure to the total stock market. There are funds that give you exposure to the largest 500 companies in the stock market. This is called the S&P 500. There are funds that give you exposure to tech stocks. There are funds that give you exposure to healthcare stocks. There are funds that give you exposure to real estate companies. So now you can start thinking, what do I want exposure to? Do I just want exposure to the broad stock market? Do I want exposure to the largest companies in the stock market? Do I want exposure to a particular sector? Once you know that, now you can just find the right fund that will give you that exposure. Now, the big difference between something like an index fund and a mutual fund are the fees, because the fees are going to depend on how much work is required to manage the fund. Index funds are generally passively managed versus mutual funds are generally actively managed. What that means is actively managed funds are managed by a person. Passively managed funds, because they're managed by a computer, are much lower fees, meaning much cheaper to invest in than an actively managed fund, because now you're trying to bet that this person who charges a higher fee will now get better returns. Now, what we've seen happen throughout the last number of decades is that generally over the long term, this money manager cannot outperform the passively managed funds that are giving you exposure to the market once you factor in the fees. So sometimes these fees will be worth it, most of the times not. ETFs, on the other hand, can be either passively managed or actively managed, but the biggest difference between an ETF and an index fund or a mutual fund is how easily you can access an ETF, because ETFs trade just like any other stock. You can buy and sell a stock within the same second or within the same minute, versus most index funds and mutual funds you cannot. Most mutual funds and index funds have other restrictions, like limitations on how much money you have to invest. Some might require $2,000 to start investing into either one of these. They might have limits to how often you can trade them. You might only be able to buy it or sell it once in a day. ETFs, on the other hand, don't have those restrictions. You can buy or sell an ETF whenever you want, as long as the market is open. A couple examples, something like VTI. This is an ETF created by an investment institution called Vanguard, which gives you exposure to the entire stock market. So when you invest in VTI, you're investing in the total stock market. Another one would be something like SPY. Now, as a little bit of a disclaimer, while I'm giving you these as examples, I'm not telling you what to invest in. You need to do your own research, because one, investing has risks, and two, you are never guaranteed to make money when you invest. You might even lose money, which is why you need to do your own due diligence and never blindly trust a random guy on YouTube. SPY is another ETF that gives you exposure to the S&P 500. The S&P 500 are the largest 500 companies in the stock market. You can invest in an ETF like DIA. DIA is an ETF that gives you exposure to the Dow Jones. You might have heard of the Dow Jones. Well, if you invest in DIA, now you're investing in the Dow Jones. You can also invest in an ETF like QQQ. QQQ is an ETF that gives you exposure to the NASDAQ. So now these are different types of ETFs that give exposure to different indexes, and there are so many different ETFs out there. You just have to figure out first what it is that you want to invest in, then see the different options that there are. The easiest way to do that is just to do a quick Google search. There are a lot of different options out there. This is not even close to a comprehensive list, but it's a way for you to start thinking about what it is that you want to invest in. Now, when we talk about creating an automatic passive investment, what you can do is say, all right, I want to take a piece or all of this investment portfolio that I have, and now I want it to be automatically invested into my passive investments. This is where now you have to decide how involved you want to be with your investments. Do you just want to invest your money and not have to think about it? Well, then maybe you invest all of this money into your passive investments. If you want to be more involved with your money, maybe you don't do any passive investing, or maybe it's a hybrid. Me personally, I invest my money in 5 places. I invest my money into my own businesses and startups that I invest in. I invest my money into physical real estate. I invest my money into stocks. I invest some money into crypto, and invest some money into physical gold. When it comes to my stock market investments, I have my passive investments, like we just talked about, and I also have my active investments, which we're going to talk about in just a second. So you got to decide what do you want to invest in and how do you want to invest in it. In these passive investments, it can be completely passive and automatic, but the key here for you to succeed as a passive investor is you want to be investing for the long term, the next number of decades, not just the next number of years or the next number of months. Passive investing is a long-term game. That's where you're going to see the real wealth, and the way that you win is every week or every 2 weeks or at least every month. You want to be consistently, passively, and automatically investing your money into the markets. There are brokerages out there that will automate the whole thing for you, that are free of charge, that will allow you to invest your money into your passive investments, and they will do it without you having to manually do it. It's completely passive, so you turn it on and it will happen by itself. I use a platform called M1 Finance. They are an affiliate from Minority Mindset. They've been a previous sponsor from Minority Mindset, meaning if you use them, you will get compensated. But for M1 Finance, I have my link down in the description. The reason why I like M1 Finance is just because it's so simple to use and because, well, they specialize in this type of passive investing. So for me, every Wednesday, money leaves my checking account and is automatically invested. Why Wednesdays? Because I used to have it on Fridays and I used to have it on Mondays, but many federal holidays fall on Fridays. So the markets would be closed, which meant the money was not being invested on those days. So I just picked the middle of the week because now it's less likely to be closed because of a federal holiday. So no secret sauce or science behind the day, but for me, I have it so every week I have money leaving my checking account and it's automatically being invested into my portfolio of ETFs. That way now I have my passive investing system working to help build wealth on the side. So now we talked about investing your money in retirement accounts. We talked about investing your money passively. Now let's talk about investing your money actively, which is the fifth thing that you need to understand is how do you invest your money passively? Now, there's a lot of different ways that you can do this. You can do this in the stock market. You could do this with real estate. You could do this with businesses. You could do this with really anything where now you are researching an investment, a particular investment. You're doing the work to find an investment, and you're not trying to flip it for a quick profit. That's trading. When we talk about active investing, I'm still talking about long-term investing because real wealth is built over the long term. You don't build real wealth in the short term. That's trading, that's speculating, that's gambling. I don't do that. So when we talk about active investing, I'm talking about investing money for the long term, but now you're looking for individual investments that you can invest in based off of your research that you want to hold on to for the long term. Now this could be stocks. You're looking for the right company that you believe will be a good investment. But this comes with higher risk. Like you could go out and invest in the Amazon Corporation. That is an active investment. Now, if you invest in Amazon for the long term and Amazon takes over the world, well, now you're going to see a big return on your investment because that means that Amazon's going to have bigger profits, their stock prices go up, and you're going to make more money. But if the CEO of Amazon runs the company into the ground and now Amazon is losing money and they declare bankruptcy, well, now your investment goes down to zero and you lose all of your money. So you have higher risk, higher potential return, but you also have the potential to lose more money. That is how active investing works. So the way it works in the stock market is now you are looking for individual companies. This means now you're looking for good companies. You're going to be listening to the earnings calls. You're going to be valuing the companies, keeping up with the company, and then see if it's a good investment for you. This is not how most people should be investing, but if it's something that interests you, then this is something that you can do. I like it, which is why I do active investing in the stock market and passive investing. I also actively invest my money in real estate. When I talk about actively investing my money in real estate, I'm not talking about buying a home for me to live in. I'm talking about buying a rental property. It might be a home to rent out to somebody else. It might be an apartment complex. The reason why is because now when I invest in real estate, I'm getting three things. Number one, I can get cash flow. Because now I'm working to buy this property, an apartment complex, a home, that way I can rent it out to somebody else. Now when I can do that, I'm getting cash flow because now the rent that I'm getting should cover the expenses. It should cover the property taxes, the insurance, the maintenance, the management fees, and the vacancy costs. That way now every single month is putting some money in my pocket. That's why I like investing in real estate because it gives me that sort of cash flow. The second benefit of real estate investing is it gives you tax breaks. As an attorney who's not your attorney, I can tell you that real estate offers some of the biggest and best tax breaks that our tax code has to offer. This is why so many wealthy people love investing in real estate. So when people get money, they like to put it in these real estate investments because now the real estate will give you cash flow and it will protect your wealth with tax breaks. And number three is it gives you a hard asset. Because when you take your cash and you save it in the bank, your savings are losing value to inflation. versus with real estate, over the long term, we have seen real estate values rise. Why? Well, part of the reason is because the cash that we're using to buy the real estate is dropping in value. And second is because if you're investing in real estate in a good area and the demand to be in that area is growing, well, now the value of the real estate is also rising. A third way that you can actively invest your money is to invest in startups. Now, this has become much more accessible now thanks to the internet, but it's still very risky. What you have to understand with the startups is that 90% of startups will fail. Meaning most of your startup investments will go down to zero. That's one of the pros and cons of startup investing, is that you're probably going to lose money. But if you hit your money on a good startup, well, now you can make all your money back plus more because you made a good investment. So this type of startup investing is high risk, high potential reward. You got to understand that going in, and you have to understand that most of the time you will lose money. Even when I invest in startups, I know that most of the startups that I work with and that I invest in are going to go bankrupt or they're going to go nowhere. That's just how the statistics work. Now, there are some platforms online that make startup investing like this much more accessible. One of them is WeFunder, one of them is Republic, one of them is Start Engine. Do your own research, see which one you like, and I gotta let you know that I personally am an investor in the WeFunder platform, but do your own research, see the ones that you like the best. Now, the advantage of these new platforms to allow you to invest in startups is that now you can start investing in startups with as little as $100 versus before, if you wanted to invest in startup companies, you would need hundreds of thousands of dollars typically to get started, because then you need the money to find the companies and then to fund the companies and then to manage your investments as well. And the last active investment that I want to highlight is paying down your debt, because paying down your debt is an investment because it's going to give you a guaranteed return. If you have a 6% mortgage rate and you take $10,000 and you pay off this mortgage rate, well, you get a guaranteed 6% return on that money, because that's 6% that you don't have to pay in interest on that principal. Just one thing that I want to remind you, that when you do pay off your debt early, you want to make sure that when you pay this payment, that you want it to apply to your principal balance, not your future payments, because if you apply it to your future payments, well, you're just paying next month's payment early, versus when you apply it to the principal, that's less money that you have to keep paying interest on. So now this is where you have to make the decision. Would you rather pay down debt right now, or would you rather use your money to invest it into something that's going to grow? And this is going to depend on your lifestyle, it's going to depend on your risk tolerance, and it's going to depend on what type of goals that you have. If you want to live big and you want to go for it all, well, then you got to take more risks with your money. If you just want to be financially free and not have to worry about money and never have to stress about money again, well, then you can work to pay down your debt, because that's going to relieve a lot of that financial stress. So now we talked about how to automate your finances. We talked about why you need to live below your means. We talked about different ways to invest your money. You can invest your money into retirement accounts. You can invest your money passively. You can invest your money actively. And we talked about why you need to save your money strategically. And this brings us to number 6. Let's differentiate assets and liabilities and needs versus wants. Once you get to this point, usually what happens is people get excited. They start to see the prospects and the potential of what happens when you invest your money, because now you can see the potential growth of your money, the potential growth of your wealth, and now you get excited. I want to do more of this. Well, if you want to do more of this, you're going to need more money to invest. And the first way that you can get more money to invest is just to spend less money. And the first way to do that is to understand the difference between an asset and a liability. Because an asset is something that puts money in your pocket. It's something that you buy for the sole purpose of making money, versus a liability is something that takes money away from you. And what ends up happening so many times is when we go to spend money, is we justify liabilities as assets. We call these things which are money pits assets, so we can justify spending more money. What's an example of this? Your car. Many times people talk about their car being an asset. I don't know why, but cars are known to be liabilities. They lose value. So if you're going to be buying a car, you want to make sure you can buy a car that you can afford comfortably, ideally with cash, that we don't have to finance something that's losing you money. Now, many people hear that and say, wait, what do you mean, Jaspreet? How am I going to afford the BMW in my driveway with cash? Well, maybe you shouldn't have a BMW, because that BMW, which is costing you $500 to $700 a month, is eating away at your future wealth. Instead of spending $500 to $700 a month for the rest of your life on a car, because as soon as you finish the payments on this, you're going to go and buy a nicer car and then start the payments all over again. So you end up paying payments for the rest of your life on your car. Instead of doing that, go and buy a $7,000 Toyota Camry or Toyota Corolla with cash. I know it is a downgrade from your BMW, but now you're no longer have to make the payments. Now that you don't have to make the payments, that's $500 to $700 you can put towards your investments. It's the same with your house. Everybody, I used to be a real estate salesperson. Everybody talks about how the home that you live in is an asset, it's an investment, it's the biggest investment that you're ever going to make. Well, in reality, for the vast majority of people, your house isn't an asset. Actually, it's a money pit. Your house is only an asset if you can sell it for a profit. But that assumes that you're going to be able to sell it for a profit. That assumes that the economy is going to be strong when it goes time for you to sell it. And that assumes that you're not going to have to sell your home when you're in a recession in the housing market. And that also assumes that you're going to have to sell the home that you live in order to actually get the money out from your home. Your home is a money pit until it becomes an asset, if it ever becomes an asset. And until you get to that point, it's costing you money every single month. You have to pay for your mortgage, you got to pay for your property taxes, you got to pay for the water bill, you got to pay for the heat, you got to pay for the gas, and then you got to pay for the upgraded bathroom. You got to pay to upgrade the basement. You got to pay to upgrade the bedrooms. You got to pay for all the maintenance, and you got to pay for everything else until it comes time for you to sell. And when you keep believing that the home that you live in is an asset, it's so much easier to get you to spend more money on the home that you live in. Why would you live in a small home when you can live in a big home and build generational wealth in this big home, and then it becomes an even bigger money pit? When in reality, if you really want to build wealth, what you should be doing is taking that money and using it to buy a rental property, using this money to buy more assets that are actually paying you to own them, because now you're buying these assets with the purpose of making money. You buy the home that you live in with the purpose of making memories. There's nothing wrong with owning a home. There's nothing wrong with having a big home. Make sure you can afford it first, and don't sacrifice your future wealth just so you can have a big home, because that big home is money that could be used here to give you even more wealth, which will allow you to buy an even bigger home in the future and not have to worry about the price. This is where now understanding an asset versus a liability, not justifying a liability as an asset just so you can drive bigger and have bigger, because yes, you need a car to get to and from work, you just want a BMW. You need a home to live, you just want a mansion. And understanding that difference, that way now you can prioritize this over this, will allow you to live bigger in the future. And the reason why this is so hard is because now people have to take a step back and say, you mean that I'm going to have to live smaller? What are people going to think? What are people going to say when they see me go from this lifestyle to a smaller lifestyle? People are going to think I lost my mind. Well, if you're so worried about what other people are going to think, it's going to be very hard for you to ever achieve any real wealth. And this is where you have to understand, what would you rather have? Would you rather have the wealth? Because wealth is built here, wealth is not built here. And in order to have the wealth here, you're going to have to make sacrifices here. And if you're not okay making that sacrifice, well, you're going to continue making everybody else rich. Because when you spend this money, you're making other people rich. When you spend this money, you're making yourself rich. And what I'm saying is, make yourself rich before you make everybody else rich. Nothing wrong with having nice things. Nothing wrong with having luxury things. Nothing wrong with having expensive things. Just make sure you can afford it first. That means take care of yourself and make yourself rich before you make everybody else rich. Going along with that is number 7, which is stop living off of debt. See, so many people in America live in this consumerism culture where it's completely normal to spend money, not based off of how much money you have in the bank, but based off of how much money you can qualify for, which means you make $1 to spend $2. This is why it's completely normal to have credit card debt. It's completely normal to finance your car. It's completely normal to go to the Gucci store, not have money to buy that $2,000 handbag, but then finance it with Gucci's new credit card or whatever they're offering, which means now you can buy things that you can't afford with money that's not yours. And now you're going to spend your next month's income and next year's income not buying more things, not building more wealth, but paying off your previous non-wealth building expenses. This is where the best thing for you to do when it comes to spending money is to not spend with debt, unless it's something that's going to make you money. The only exception to this is your home, but for everything else, from your car to your groceries to everything in between, you should not be financing these things if it's not putting money in your pocket. And this can be hard, especially when you're in this culture where everybody finances everything. Why pay full price when you can pay it off in installments? Well, when you pay it off in installments, you don't feel the real pain of spending money today, even if it's 0% APR. And most people say, why would I not want to pay 0% APR on my $1,000 phone and pay it off over 18 months, because then I can just invest the money today? Because most people don't invest that $1,000 today. What they end up doing is they finance their phone with 0% APR over 18 months, and then they go out and they finance a laptop with 0% APR over 18 months, and then they go out and they finance a TV over 18 months with 0% APR. And now you spend way more money today than you would have if you actually spent that whole $1,000 today and you never end up actually investing that money. That's why instead of playing that payments game, instead of trying to keep up with the system, pay it off with cash, never have to worry about the payments, and make more money. That way you can actually afford what you want to buy and never have to worry about the price. And this even comes to your house, because what ends up happening to a lot of people when you are in a booming economy is you buy this home right here. You bought this home for, let's just say, $400,000. And now a number of years go by, the economy starts to boom, the housing market booms, and now you find out your home is worth $600,000. Well, again, this $600,000 doesn't really mean anything unless you sell the home, but now you don't have a home anymore. Or you can do a cash out refi, which sounds great. You can pull out $550,000 from your home, pay off your previous loan, and now you have $150,000 in cash in your pocket to do whatever you want. And then what do people do? They take this cash and they go out and they buy a boat. They go on some nice vacations. They buy a better car because now you have this extra cash in the bank. Well, when you live off of your net worth, you're spending money that's invisible. Because then if you go into a recession, the housing market slows down, and then your home value goes back down to, let's just say, $400,000. Well, you took this cash and spent it. You have to pay this money back plus interest. But the asset that you use to finance it isn't worth as much as you thought. So now you're the one that's left with the debt. You're the one that's left with the payments, and you're the one that's left with all the fancy liabilities that aren't worth as much as you thought. This is where if you're going to be spending money, buy what you can afford with cash. Don't use debt to buy anything unless you're buying it with the purpose to make money. If you're buying something that's going to make you money, now we can talk about using debt strategically. But if you're buying something that's not making you any money, don't use debt unless it's your own home. But even then, make sure you can afford the home that you're living in. That means afford the down payment and afford the monthly payment. That way it's not sacrificing your future wealth. You should still have money to invest, even though that you have this home that you have to pay for. Number 8, this is where things get really fun, because now you know how to spend your money the right way. You know how to invest your money the right way. You know how to save your money the right way. And now you're gonna really start loving this whole financial education thing. You're gonna love this investing thing because you're building wealth. And your next question is, how do I do more of this? Well, if you wanna fuel this financial education and you wanna fuel this investments, that means you're gonna need more money. How do you earn more money? Because the more money you earn, the more money you're going to have to invest. And we already talked about how you can invest more by spending less, but I want to show you this little chart right here. Because what ends up happening to so many people is you say, okay, I'm earning $40,000 a year, and this is how much I'm investing. I'm investing $10,000 a year. And you say, you know what? I want to invest more money. So now you try to go from here to here. You try to go from investing $10,000 to $12,000 a month. And then you go from trying to invest $12,000 a month to $13,000 a month. You're trying to squeeze more pennies out of this pie, which can be good in the short term, but there's going to be a limit to how many pennies you can squeeze. There's going to be a limit to how much you can save, but there's no limit to how much you can earn. This is where I want you to remember a couple things. Number 1, a penny saved is just a penny. And 2, I want you to build a growth mindset and think bigger. If you want to be able to invest more money, you can also work to grow the pie, where now instead of earning $40,000, you're earning $400,000 a year. And if you invest that same ratio, now you're not investing $10,000, you're investing $100,000. And the first thing you're going to say, I already know, is Jaspreet, my boss isn't going to give me a raise from $40,000 to $400,000, and you're 100% right. This is where you're going to have to be a little bit creative and start thinking outside of the box. Because as soon as you think that, oh, I could go from $40,000 to $400,000, now you're going to start thinking a little bit differently. And you're going to start acting a little bit differently, and you're going to start learning different things. Now you're going to start watching YouTube videos on how to earn more money. You'll start reading blogs on how to earn more money. You're going to start reading different books, and you're going to start absorbing different content and doing different things to earn more money. If you want to earn more money, you can do it from your job. You can try to get a raise or promotion. You can try to get a second job, or you can try to do something on the outside. You can try to create a side hustle. You can try to create your own business. You can try to create your own income. That way now you can earn more money, because there's no limit to how much money that you can earn. But there's a limit to how much money you can save. But in order for you to do that, you have to start thinking differently, and you have to believe that it's possible for you. Because if you don't believe it's possible, you're right. It's never going to be possible. But if you believe it's going to be possible, well, you're going to start thinking differently. And that's going to change your actions, and it's going to change what you learn, and that's going to change what you do. It's not going to happen overnight, but maybe over the next 10 years, you'll be able to 10x your income, because now you're working for something completely different. You're not just working for a raise at your job, you're working to really increase your wealth, because that will allow you to invest more money. Remember, the key here is, why are you earning more money? You're not just earning more money that way you can spend all of it. You're earning more money that way you have more money to invest. Number 9 is understand taxes. In America, as an attorney, I can tell you this, but I'm not your attorney, so make sure you talk to a professional in your area if you have specific questions. But in America, we have 3 different categories of income. You have earned income or ordinary income, you have portfolio income, and you have passive income. All income is not treated the same. Earned income is your W-2 income. This is the money you make from your job. Portfolio income is the money you make from your investments, your stock market investments. You buy a stock and you sell it for profit more than a year later. Passive income is the income you get from your rental properties. Do you want to know which category of income has the highest tax rates and the lowest tax deductions? Well, it's this one right here. It's the income you make from your job. Because the way it works for most people is you go to work, you get paid, you pay taxes, and then you have to spend whatever's left. But things start to change if you're an investor or a business owner, because now the way it works is you earn money, you can spend money, and then you pay taxes on whatever's left. Our system is designed to benefit the investor and the business owner. Now, you don't have to go out and start a business. You can still take advantage of some of these systems by being an investor, but you have to understand how it works, that we can actually take advantage of it. See, when most people want to buy a phone, they want to buy a car, they want to buy a laptop, you have to earn money, pay taxes, and then with whatever money is left after paying taxes, you can use to buy a phone, your laptop, or your car. When you own a business, it can be a little bit different. Like for me, I need a phone to operate my business. I need a laptop to operate my business. I need a car for my business. So I make money, I spend my money on these things, these become tax write-offs, and I pay taxes on whatever money is left after spending my money on these items. It's completely different. And then when you earn money from your investments, well, your taxes are also going to be different. Like if a doctor earned $1 million from being a great surgeon, you might be left with half of that. $500,000 after paying for all of your federal taxes, your state taxes, and payroll taxes. But if an investor made $1 million for selling an investment for $1 million profit after owning it for a year, well, now your top tax rate today is 20%, meaning you're going to be left with $800,000 if you earn this money from an investment. Maybe a little bit under $800,000 depending on some of the other rules out there, but around $800,000. You keep $500,000 if you made that money as a doctor. You keep $800,000 if you made that money as an investor. This is why it pays to understand taxes and why you need a great tax advisor in your area, because our system is designed to benefit the investor and our system is designed to benefit business owners. Now, what does that mean? Well, now that you're becoming more financially educated, not only do you get the benefit of becoming more wealthy, you also get the benefit of the tax law. And finally, now number 10 is protect your wealth. This is where now you're working to build wealth, you're working to implement these systems, you're working to build a financial education. This is where you want to make sure you protect yourself. This means you have to talk to an estate planning attorney. That way you can build a plan for your wealth after you die. What's going to happen to your money after you die? If you don't create one of this, then it could be the government that decides where your money goes, and that could create a lot of conflict with families. So go talk to an attorney, talk about a will, talk about a trust, and go get something created. It's a little bit of a cost, but it will save a lot of headache for your family after you go. In addition to that, make sure you have the right insurances for yourself. This could be your health insurance, car insurance, home insurance, investors insurance. This for things like landlord's insurance. If you're a real estate investor, if you own a business, you want to make sure you have your own business insurance. There are so many different types of insurances out there. It sucks to pay for them, but it's a small price you pay for a huge peace of mind in the future, because if you get sued, well, now you're going to have to work to either settle the lawsuit or come to a conclusion with the lawsuit. And this is where you want to make sure you have insurance there to protect you. And of course, this is where you also want to make sure that you're also giving back. The more you have, the more you can do. And this could be giving back with money, this could be giving back with time, this could be giving back with knowledge. The more you have, the more you can help. Most people say that the secret to not being broke is to never go inside another Starbucks, but that's not true. If you really don't want to be broke again, there are 15 things I want you to do, and I'll show you. The first thing that I want you to do is grade your finances. And the way that you do that is to take a piece of paper. You can do this on a Google sheet, an Excel sheet, or whatever, but you need to see where all your money is coming from and where all of your money is going. So you're going to start by writing your income and your different income sources. This might be your job, it could be your business, it could be your investments. See all the money that came in. Then you're going to subtract every single expense. Take your credit card statement, take your debit card statement, take your bank statements, and look where all of your money went. Now, ideally, you're going to categorize this by these are my eating out, these are my groceries, this is everything else. So you're going to categorize this by the different types of expenses that you have. That way now you can see your income, you have your expenses, and then you have whatever's left. And then you can see, did you invest this money? Did you save this money? Did you put some of this money to charity? What are you doing with this money? You need to see this in order to actually be able to improve your finances, because in business, what they say is if you can't track it, you can't optimize it. Well, it works the same way with your money. If you don't know where your money is going, you have no way to actually improve what you're doing with your money. And the reason why this is so difficult is because this is almost like giving yourself a report card. Nobody liked getting their grades when you were in math class in high school. Well, now when you do this, you're going to have to take a look at what's actually happening with your money. And I can guarantee you, the first time you do this, you are going to be shocked when you see where your money is going. And immediately, I don't even have to tell you what to do. Immediately, you're going to find ways to cut expenses and have more money. Number 2 is spend less than what you make. Once you see how much money you brought in, you cannot spend more than that money, because if you don't have any money left over, you can't invest your money to build wealth. You can't save your money to protect you, and you can't give any money back because you're spending all of your money. This means now you got to start spending less money strategically. Where can you start spending less money? Well, you got to see where your money is going in the first place. Maybe you eat out less. Maybe you stop buying so much stuff. Maybe you can't afford to go on those vacations right now. Maybe you can't afford a monthly massage membership. See where your money is going, and then see where you can cut back on some of these expenses, because if you're spending more than what you bring in, well, you will never be able to build wealth. Number 3 is pay yourself first. And the first time I heard that, I thought that meant that when I pay myself first, I'm going to spend this money here first. I'm going to spend money on a nice vacation to treat myself, or I'm going to buy myself a nice car, or I'm going to buy myself this nice thing. That way I can pay myself and treat myself. But paying yourself first does not mean treating yourself first. That means building your wealth first, which means always spending money here first. Investing your money first. And the way that you do that is by creating a system where now no matter how much money you get paid, you always put aside money to invest. You always put aside money to save, and then you spend whatever's left. The biggest mistake the majority of people make when it comes to their money is they spend their money first and then they save and invest whatever's left. But if you want to become wealthy, and what wealthy people do is they invest and save their money first, and then they spend whatever's left. The simplest way that you can do that is by following something like a 75-15-10 plan, which says that for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest. 10 cents is the minimum that you save. Now what you're doing is anytime you get paid, you're always paying yourself first, because you're always investing your money. The more money you make, the more money you invest. You're always saving your money. Now a little caveat here when it comes to saving, because when it comes to your saving, you don't want to just keep saving your money forever. You want to save your money strategically, and that means saving somewhere between 3 to 12 months worth of expenses. So figure out what your monthly expenses are, multiply that by 3, multiply that by 12, and this will give you a range for how much money you should save. Once you hit that amount of money that you want to save, then you can stop saving and reallocate this money here to your investments, because this is what's going to make you wealthy. This is what's going to protect you against an emergency. This is what allows you to live your life and enjoy your life by having the nice things. This is the money that you can spend, and of course, I want you to give back too. Give money to charity. Give your time. But I also want you to remember that the more you have, the more you can do. And this is why you want to make sure you can take care of yourself, because if you are hungry, you can't feed another hungry person. But if you can fill your cup, if you can take care of your finances, you're going to have the ability to give back and do more. So always give back. But also remember, you need to make sure you take care of yourself, that we have the ability to give back. Because most people talk about the importance of giving back, but they have nothing to give. You got to make sure you take care of yourself, that we actually have money and have wealth to give back. Now, don't get me wrong, you don't have to be a millionaire to start giving back, and you can also give back your time. I'm not saying you can't do that. What I'm saying is if you can take care of yourself, you can take more care of other people. The more you have, the more you can give. Number 4, if it's not paying you, it's not an investment. If you're walking around paying extra for the Nike, you're paying extra for the Gucci, what you got to remember is you're a walking advertisement for Nike and Gucci. Now, there's nothing wrong with that. If you like the Nike, if you like the Gucci, and you can afford it, no big deal. But if you're broke, if you're struggling with money, you don't need to be paying a premium to be wearing these brand name products to advertise their stuff, to walk around as a walking billboard, when you're not getting paid to do that. Because now you're paying Nike, you're paying Gucci to advertise their products. Again, don't get me wrong. Nothing wrong with having nice things. There's nothing wrong with having expensive things. There's nothing wrong with having luxury things. I want you to have all the nice things, but I want you to be able to afford it. If you are broke, if you don't have money in the bank, if you don't have an investment, if you don't have an emergency fund, you should not be walking around with Gucci on your belt or with Nike on your feet. You need to have something that can actually take care of your feet and keep your pants off, but you should not be walking around with Nike on your feet and Gucci on your belt. Number 5 is you can turn your annual income into your monthly income, which means if you're making $50,000 a year right now, guess what? You can potentially turn this into $50,000 a month. And when you hear somebody say that, you're going to think they lost their mind. Because when you're here making $50,000 a year, going to $50,000 a month is going to seem like a million miles away. It's not even going to seem possible in this lifetime. But the reality is, it is possible. Does that mean it's easy? No. And is it going to happen by doing the same thing that you're doing right now? No. But it is possible, but it's going to require you to first understand and believe that it's possible, and then work to actually achieve this. Now, what do you actually do to achieve this? The first thing you gotta do is start learning about how you can earn more money. What can you do to create an income? What can you do to build a business? What can you do to create a new stream of income that can allow you to 10x how much money you're making? Where can you figure this out? If only there was a platform on the internet that allowed you to watch and learn from other successful entrepreneurs, where people could talk about what they did and you could see what they did and watch it happen in real time without you even having to pay anything. If there was only a platform on the internet. Start by watching YouTube videos, then read books, then take action, then maybe buy some classes, then take more action, then maybe buy some coaching. The more you do, the more you'll realize that making more money is possible, but you're going to have to put in more work and you have to do more learning to try new things and figure out new ways to earn more money, because sometimes all we need is a little taste of knowing that it's possible to earn more money. And once you have that taste and you have the drive and you have the desire and you have the willingness to learn, then nothing can stop you. Number 6, get rid of your car payment. The average new car payment in America right now is $717 a month. Do you know what this means? This means that if you're worried about gas prices, you can't afford this new car payment. $717 a month for a new car payment is the highest number we've ever seen. Now, of course, let me give you the normal analysis that everybody does. If instead of having a car payment, you took the $717 a month and you invested it, and let's say you could get just a 7% annual return on your money, which is below the historical average. If you just invested your money into, say, the S&P 500, and you did this for, 40 years, well, instead of having a car that's worth nothing in 40 years, you would have almost $2 million. Now, you're going to be saying, but Jaspreet, I still need a car to get to and from work. What do you want me to do? Well, what you can do is take that $8,000 down payment that you put to buy this car, and instead of using that as a down payment to buy this car, take that $8,000 and use it to go out and buy a car with cash. Yeah, you're not going to get the BMW, you're not going to get the Benz, but you're going to get a nice Toyota, maybe a nice Honda. And now this car will take you from where you got to go to where you got to go without this expensive car payment, without the premium gas, without the expensive insurance. And now you don't have to take this money and give it to your car dealership or your bank every single month. You can take this money and put it to work. That way it can actually make you richer instead of just making BMW and Mercedes-Benz richer. Number 7 is make less speculative investments. When most people are in the early stages of trying to build wealth or start investing, we get attracted to this old idea of trying to get rich quick. Now, most people don't actually know it's get rich quick because we've all heard that get rich quick schemes don't work. So instead, what do? We look for the next hot meme stock. We look for the next hot cryptocurrency, and then we dump our money into these things which make money for some people, but everybody else ends up losing a big chunk of their money. And so instead of looking for the next hot stock or the next hot thing, invest your money into something a little bit less speculative that's going to make you money over the long term. And I learned this lesson the hard way too, because when I first started investing a long time ago, I started getting into this idea of day trading because people kept talking about how much money you can make day trading. And then I learned about this thing called penny stocks. Now you could day trade penny stocks and you could double your money in a day. And it was very addicting and very exciting. And so I took a whole summer when I was in college, and all I did was day trade. I was day trading primarily penny stocks. I would wake up before the bell. I would be researching the articles, researching the forums, and then see what stocks to trade. And all day long, I'd just be making trades. And by the end of the summer, I had spent spent hours of my life now consumed by day trading, and I don't think I made any money. I don't really think I lost that much money, but I was right around break even after a whole, I don't know how many months, and that's when I realized that I want to be an investor, not a trader. Now, my investment portfolio looks something like this. And of course, I'm not telling you what to do, I'm just telling you what I do, and I should also let you know that investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point, so make sure you understand that before you go in, and never blindly trust a random guy on YouTube. So my investment portfolio looks like this, which is 75% of my investment portfolio are cash flow producing assets. This could be my physical real estate that pays me with cash flow. This could be my stock ETFs that pay me with dividends. And these could be actual stocks that pay me with dividends as well, non-ETF stocks. So 75% of my portfolio are cash flow producing assets. Then I have this smaller piece of my portfolio, which are things like stocks that don't pay dividends. And then I have this part, which is somewhere between 10 to 15, maybe 20% of my portfolio, depending on the day, which is my speculative investments. These are things like the startups that I invest in. These are things like my cryptocurrency investments. These things are speculative. I know that there's a high chance that this could go to zero, and there's a high chance that this could also grow very quickly. So many of these, or some of these, might go to zero. Some of them might grow big. At least that's what we hope. But it's very speculative, and I also understand that if this went to zero, I really wouldn't be affected that much. And then here I have this teeny tiny piece, about 2% of my portfolio, which is physical gold. This is what my portfolio looks like. So I have the 75%, which is paying me with cash flow, whether or not, well, I do anything, because this is cash flow producing assets. So now, this is a long-term portfolio for me, because now I'm not looking to sell my portfolio tomorrow, in 6 months, or even in 6 years. I'm looking to hold on, to accumulate, to build, and to grow over the long term. And so for me, when I invest my money, I'm not looking to invest for 6 months. And if you want to actually make money with your investments, well, you might want to consider not trading, not finding the next hot stock, but rather investing in something that has good long-term value, because that can make you way more money over the long term than just trying to trade and finding the next hot stock, because that has the most risk, which means you can also lose the most money very quickly. Number 8, when you inflate your income, don't inflate your lifestyle yet. The biggest mistake that so many people make when they get a raise, when they get a bonus, or when they get a promotion is they blow all of their money. There are so many people, actually pretty much everybody, who says that their financial problems are because they don't make enough money. And then what happens is you get a raise, you get a bonus, you get a promotion. So you make more money, and then all of a sudden, boop, your expenses shoot right up with it, because now you got to celebrate. If you get a raise, you got to get a new car. If you get a bonus, you got to go on a vacation. And this is where now, if you actually want to have more money for yourself, when you go and get a new raise, don't go and spend all of your money. And now, if you do that, you can increase your income faster than you can increase your expenses. Now you will always have more money working to make you wealthier, and every time you get a raise, you will actually become wealthier instead of just looking like you're richer. And if you want to look like you're richer, well, you want to actually become rich and wealthy first, because now you have the assets. And when you have the assets that can pay for your lifestyle, now you can buy whatever you want without having to worry about the money, because you have the investments that will pay for you. Number 9, don't make emotional financial decisions. And this can be with your investments. Panic buying or panic selling. When we hear about the next hot stock all over the news, on Reddit and everywhere, people are talking about how much money they're making. It can be very interesting and exciting, and you want to come in and buy. Maybe even margin up your investments, leverage up your investments, that way you can make even more money. And then on the flip side, when you hear about the market crashing, when you hear about a recession, when you hear about a stock crashing, now you'll want to panic and sell before everything goes down. The markets, especially the stock market, runs a lot on emotion. And the people that actually make money are the people that invest their money not on emotion. And this is where, if you can take the emotion out of the equation, you will have the ability and the psychology to make way more money. But the reason why this is so difficult is because, well, the internet fuels this emotion. The media, traditional media, fuels this emotion. Because when things are good, the traditional media will keep telling you about how the world will never end, about how the money is going to be great forever, and how this stock, this investment, this thing will keep making so much money, and you have to come in now before you miss out on the opportunity. Then when things start to go down, it flips. You don't hear, oh yeah, it's having some issues. You hear the world is ending. You hear this company is going to go down to zero. You hear that everything is going to go down, and you need to sell and get out while you can, which creates so much emotion. And then Now on the internet, we have forums, we have people where they can talk to each other and people get emotional, and now everybody keeps talking about how the world's gonna end or how you can never stop making enough money. And it's this polar extremes in money and polar extremes in emotion, which fuels people to do dumb things with their money. And this is where now, if you want to make smart spending decisions, if you want to make smart investment decisions, you got to pull the emotion out. I'm talking about your investments right now. But it's the same when you spend money. When you go to the store, instead of just buying things because everybody else on Instagram has it, buying it because you want it, or buying it because you need it, and then buying it because you can afford it. It's a completely different way of looking at money when you pull that emotion out. Number 10, stop financing things that don't pay you. Just because you can buy something doesn't mean you can afford it. If you have $100 in your bank account, that doesn't mean that you can afford to buy a $200 pair of shoes just because you can finance it. And just because you have $100 in your bank account doesn't mean that you can afford a $100 pair of shoes. Now you might be saying, but Jaspreet, what do you mean? If I have $100, why can't I buy a $100 thing because I can buy it with cash and not have to finance it? Well, now you're spending all your money to go out and buy something that isn't paying you. If you really want to be able to afford something that you don't need to survive, then you can follow my rule of 5, which is if you can't buy 5 of them, you can't afford 1 of them. With this simple rule, you will know whether or not you can afford something. Number 11, pay off your credit card before you start investing your money. Let's do some quick math. If you put your money in the stock market historically over the last century, you would be getting an average of 7 to 10% return on your money in the stock market on average. So this is stocks. Now, if you have credit card debt, let's do credit card. If you have credit card debt, you might be paying somewhere between, 12% on the low end to let's say 25% on the high end for credit card debt. Well, these numbers are bigger than these numbers. Meaning, if you work to pay off your credit card debt, that means you will get a faster and better rate of return than if you just invest your money in the stock market. Not to mention, yes, you could potentially earn more money here, but you also have the risk of losing money here versus here, you have a guaranteed return. Because these numbers are bigger than these numbers, you should pay down your credit card debt before you go out and start investing your money, because this money, this interest is skinning you alive financially. So pay down your credit card debt and then start investing. Number 12, build a savings fund and then don't touch it unless it's an emergency. Your savings fund is there to protect you against an emergency. Some people, I know Dave Ramsey calls it an emergency fund. This is cash that you're gonna put aside to protect you against an emergency. Your kid's arm breaks, your window breaks, your car breaks down, something bad happens. Now you can tap into this savings fund. Gucci having a sale is not an emergency. Black Friday is not an emergency. This is money that you're gonna put aside for an emergency, something going wrong, maybe you lose your job. That's what this money is for. How much money? Well, like I said earlier, somewhere between 3 months and 12 months worth of expenses. Then you're gonna take this cash, put it aside, and you don't touch it unless you absolutely need it. Now you might be saying, but Jaspreet, isn't this money gonna lose value to inflation? And yes, it probably will. But this money, your savings money, is not there to make you wealthy, it's there to protect you against an emergency. Your investments are there to actually make you wealthy. Your savings are just there to protect you. And so you want to make sure you have this, because then if you run into a financial hardship, well, you have cash to fall back on. Number 13 is if you have extra junk, sell it. My sister-in-law was over at our house over the weekend, and we were hanging out in the basement, and we had these old lamps there that my grandma had. And she was saying that the lamps that we had in our basement, which were just sitting in the corner, she said that these are now worth thousands of dollars each. I said, what are you talking about? These are just some old lamps. And she said, well, they're trending on TikTok and people are spending top dollar for these lamps. Now, I wouldn't go out and sell these lamps because they were my grandma's, so I want to keep them, but you never know what's going to have value. And if you have something that doesn't have the sentimental value, that's just sitting there collecting dust, and you want to make some extra cash, well, you can turn that dust into cash by selling it. Go to Facebook Marketplace, go to Craigslist, go to eBay, go to Amazon. There are so many platforms online where you can now start selling your stuff, and you can turn that stuff that's collecting dust, that's wasting space, and turning it into some cash. Number 14, this one's going to be tough, but talk to your spouse. You and your spouse have to be on the same page when it comes to money, because if you're there, you're cutting back on your expenses, you're working to earn more money, you're working to invest your money, and then you go home and you see your spouse spending all this money on a bunch of things that you think are stupid, well, that's going to create a lot of fights, and it's going to create a lot of tension. It's going to create a lot of friction between you two in the relationship side and the financial side, and this is where you got to have that tough talk with your spouse. And now you got to sit down and figure out what are your goals together and get each other on the same page of where you're trying to go. How do you sell this to them? Well, You got to tell them the goals. Because if you say, we're going to start cutting back on this, this, and this, nobody's going to want to do that, because why would you want to cut back? But if you're cutting back a little bit, that way you can have even more in the future, that's what you have to sell. You got to become a little bit of a salesperson here. You got to sell the vision. You got to sell the lifestyle that you're going to have, but you have to work to get there together. And if he or she still doesn't believe you, tell them to watch my videos. And number 15, this one might sound like the opposite, but don't chase money. Ironically, when I stopped chasing money, I started making way more money. And I know some people say this like in a real cliche way, but I seriously did, because when I first started trying to figure out how to make money, I was doing it just to make money. I started event planning and doing party promoting when I was in college, because that's all I really knew and had access to, because I was working in the wedding industry. And I was doing it not because I liked it. I actually hated the industry, because I was promoting these big club parties, but I didn't drink. I wasn't into partying. I was doing it because I was making money. I was doing it to chase money, and I was making decent money, especially for a college kid, and it got me started, and I learned a lot of things. But once I started doing things that I actually cared about, like now I make these videos about financial education. I didn't start the Minority Mindset to make money. I was busy doing other things. I had other businesses, other things that I was running. I started Minority Mindset because I really just cared about talking about the things that I wish somebody would have told me when I was getting started on my journey. I started Minority Mindset because I was scammed in a previous business that I was running. So I was just talking about the things that I wish that I knew. That way you don't get screwed over when you start a business. That's why I started. Well, now I make way more money, even though I didn't do it to chase money. And so when you really chase that value, you chase the purpose, you chase the mission, you can do a lot more. And the reason why is because now when you're working, you don't feel like working. Now, that's very cliched, and there's a lot of untruth to that, because there's some things that you're going to do that just do feel like work. Like, there's going to be days where it's going to be a grind. There's going to be some things that you don't like doing. Like, I don't like editing videos. I don't edit videos anymore, but I never liked editing videos. So there's going to be things that you don't like doing. But the purpose and the mission will drive you to keep learning and to keep going. Because starting something, doing something of your own is difficult. And when you're doing it just for the money, well, once you get the money, you lose that mission, you lose that purpose, and you have no more reason to keep going because you made some money. But when you do it not for the money, you can get the money and keep going, because now you're doing it for something even bigger, and it allows you to, ironically, attract even more money over the long term. So figure out, what is it that you're actually passionate about? What is the value that you want to solve? What is the pain that you can work to fix? And as you work towards that, what I think you will see is you're going to see the opportunity to make even more money, because you're going to be willing to put in way more work, way more effort, and be way more obsessed because you're doing something that, well, other people don't have the same passion as you. The founder of Wrigley's Gum started his company with $32 and turned his gum empire into a $23 billion corporation. I was at a dinner over the weekend, and one of the guys that was at the dinner was a young kid in college who was asking me how we can use the $1,000 that he had saved up in the best way possible, that way he could earn more money. Now, if you have $1,000, or if you don't have a ton of money saved up right now and you want to make more money sooner rather than later, the best thing for you to do isn't to just put it into the stock market or an ETF or an index fund. It is for you to take that money and do what Wrigley did. William Wrigley Jr. went to Chicago back in 1891 with the idea of starting a company. But his goal wasn't to start a gum company, his goal was to start a soap company. Now, to be fair, $32 in 1891 is worth about $1,000 today, but he went to Chicago with the idea of starting a soap company, but he had to be creative, because how could he get random people to buy his soap instead of other people's soap? So he had the idea to then incentivize people to buy his soap by giving them a free can of baking soda if they buy his soap, and now customers started buying his soap. But then he started to realize that people liked his baking soda more than they liked his soap. So then he shifted his business idea. He pivoted, and then he started selling baking soda. But then he had to incentivize people to buy his baking soda over everybody else's baking soda, because he was this random guy in Chicago trying to sell baking soda. So then he incentivized people to buy his baking soda by giving you 2 packs of free gum if you buy 1 can of baking soda. Then he starts selling his baking soda, and some time goes by, and then he realized that people liked his gum more than he liked his baking soda. So then he pivoted again, and now he started investing into his new business idea, which was selling gum, and then this became the Wrigley Gum empire that we know today. See, Wrigley took the money that he had and invested in himself, because he knew that that was going to give him the best return and could provide him the most financial freedom possible. And the way that he started was by learning. He was creative. He had to figure out a way to get people to buy his stuff over somebody else's stuff. How could he be different? He didn't start off by selling gum, he started off by selling soap. And then he offered people baking soda as a way to incentivize his customers to buy his soap. And he learned that that was a way to get people to buy his stuff because he was giving people a reason to buy his stuff or somebody else's, and he was willing to take a risk and being willing to fail. Because when he started selling the baking soda and the soap, he realized, well, when he was selling the soap, that people didn't want the soap, they wanted the baking soda. Then when he started selling his baking soda, he realized that people wanted his gum more than they wanted his baking soda, and that's when he really pivoted towards the gum side. He was failing. He failed when he was selling the soap. He failed when he sold the baking soda. Sure, he made some sales, but he never really saw the success that he wanted until he was willing to pivot again and again and again. Just because you have a business idea doesn't mean that's going to be the business idea that works, but you have to get started. If you just sit there on the sidelines, you'll never be able to figure out what is it that people want. If he sat there thinking, do people really want the best soap? How can I formulate the best soap in the world? How can I make the soap the softest in the world? He would have never gotten to the gum business because he was so focused on selling soap then, in this hypothetical example. But instead, he just got started. And then he screwed up. He realized that people wanted baking soda. So then he started selling baking soda. He didn't try to come up with the best baking soda in the world. He tried to just figure out, how can I get people to buy my baking soda? Then he learned that people wanted gum. Then when he realized that people really liked his gum, he found that product. He kept pivoting and pivoting and pivoting. Instead of spending all of his time researching and thinking, he just did it. And when you're doing it, you're learning as well. Sure, you're taking risks. Yeah, you will fail, you will screw up, but then you have to be able to pivot because that's where you're going to find the new opportunities. Then when he found the gum, that's when he started reinvesting back into the gum to make the gum the best products possible. He started creating multiple lines of gum, but he had to figure out what the right product was and how to get that into the hands of his customers. But you can't create the best product for your customers until you have customers, which means you have to be willing to learn how to get your products into the hands of customers, and you got to be willing to take the risk by actually starting. How do we take what Wrigley did back in the late 1800s and apply it to what is going on today in this new century? In today's digital economy, business revolves around attention. If you can grasp somebody's attention, you can also get somebody's dollar. But the question is, how do you get the right people's attention? Now with social media, it's how do I get someone's attention on TikTok, on Instagram, on YouTube, on podcast, on whatever social media platform is up and coming right now or out there right now. How do you get somebody to watch you, listen to you, or see what your brand is producing? And for a long time, I've been saying, you don't have to create content. You don't have to create your own content. But really, this is starting to become more and more important as I see this now, because if you are an entrepreneur, content is the backbone for so many businesses now. And going forward over the next number of decades, I believe that we're going to see a shift where most companies are going to have some sort of direct media outlet as a piece of their business, where a company is going to be working to create content as a way to educate their consumers directly about what the product is and what products to buy. You're seeing this happen more and more across the internet. And so now the question is, how do you get people to follow you, see you, hear you, and then purchase whatever it is that you're selling? And this can be in a number of different ways. Maybe you can educate people about your product. Maybe you can work to build your own personal brand. Maybe you're doing something else to get people to know about your product. When I was first starting off on the internet, I started a sock company. And the sock company had an Instagram page. This is a number of years ago, back when there was a lot of different tricks that you could use to get Instagram followers, that you could follow other accounts and you could like people's accounts and do things. This is before there was bots to do this. And so it was a very powerful tool to get people to follow you and learn about you on Instagram. And nobody really knew about this at the time. And so that was how we started to gain our initial followers for my sock Instagram page. And you might be saying, oh, but that's so saturated now. Yeah, but nobody was doing it back then because nobody knew about it. And those followers that we got on my Instagram page for the sock company were then converted to email leads who we told would get a discount when our socks first launched. And then when we launched our socks, we did just over $20,000 worth of sales in the first 30 days. And the way that I was able to get those over $20,000 worth of sales in the first 30 days without spending any money, real money on advertising, was because I had worked to build up this Instagram presence. So it doesn't necessarily have to be your face, although your face would be much more powerful. But now understanding that you have to be able to capture someone's attention, but you have to be different. If you keep doing what everybody else is doing, if you just copy other people's content, there's no reason for somebody to follow you or listen to you or hear you, because somebody else is already doing it and they're probably doing it better than you. So now you have to come up with your own vision, your own idea, and do something different. And this is where that real creativity is. How can you do something that nobody else is doing and then apply that in a way to get people to buy your stuff? But the key to make it work, like what made it work for Wrigley, was you have to be willing to pivot, because your first idea might not work. Maybe your second idea won't work either. Maybe it won't be the third idea. But if you keep trying, you keep willing to take risks, you keep learning, and you keep pivoting as you learn more about what customers want, now you keep willing to pivot to create something better. Because if you just sit there on the sideline and you keep thinking and thinking and thinking and trying to create the best product, well, somebody else is coming there and they're learning faster because they're doing it. They're taking the risks and they're already pivoting while you're still stuck here trying to figure out what it is that you want to do. Just go out there, get started, and when you get started, you can pivot as many times as you need to. Your first iteration of your company might not be the second or the third or the fourth or the fifth, but you have to get started. That way you can figure out and learn faster to get you to where your goals are.
Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things, you want to start spending money, you want to start going on vacation, you want to start buying a nice apartment, you want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money.